Stop scrolling, silver just ripped past the mid-80s and is grinding toward all-time highs. But that's not the story. The story is what's happening underneath. And if you're watching this early, you're already ahead of the crowd that'll chase headlines when the move accelerates. Your job isn't to predict where price goes, it's to understand what the plumbing is telling you. Because the plumbing always speaks first. I'm going to show you exactly what to watch, how to read it, and why these signals repeat. But I'm not answering the $100 question until we're 90% through. Stay with me. Before we dive in, subscribe if you want this type of breakdown every time markets flash stress signals. And drop one word in the comments. Watching. That's our marker. We track these patterns together. Here's what moved. Silver opened 2026 around the low 60s. Within weeks it surged 35%, pushing into the upper 80s. Industrial demand stayed strong. Solar, electronics, EV components, all pulling physical off the market. At the same time, safe haven flows picked up as Federal Reserve policy uncertainty heated up and geopolitical tension stayed elevated. That's the headline version. Here's the hidden layer. Physical premiums started creeping up even as paper futures volume spiked. Lease rates, the cost to borrow metal, rose quietly in London and Zurich. COMEX registered inventories dropped consecutively, day after day, while eligible stocks barely budged. And positioning data showed something unstable. Commercials reducing short coverage, while momentum funds piled in. Price rising? Expected. Spreads tightening, borrowing costs climbing, and inventories draining simultaneously. That's pressure building. Think about that. The market isn't just pricing in demand, it's rationing supply. And if you know how to read these signals, you see the move before the headline writers catch up. Let me show you the first mechanism. I call it the inventory valve. Here's the idea. Inventory isn't a tank you fill up and drain down. It's a valve. It controls flow. When physical demand exceeds what's available in the system, price becomes the rationing tool. Price opens the valve by choking off marginal buyers until supply and demand rebalance. You see this in oil. You see it in copper. You see it in silver. Right now, industrial draw is relentless. Solar panel production is running hot globally. Electronics manufacturers are restocking after supply chain disruptions. EVs need silver for conductivity applications. And safe haven buyers, individuals, family offices, smaller institutions, are layering in quietly as uncertainty around monetary policy stays elevated. All of that pulls physical metal off the market. Meanwhile, mine supply doesn't respond overnight. New production takes years. Recycling flows are steady, but capped. So the valve tightens. And when the valve tightens, price does the work. You don't see this in headlines. You see it in dealer quotes. You see it in delivery timelines stretching from 2 days to 2 weeks. You see it in premiums over spot inching up, even though futures are liquid and volume is heavy. That's the valve closing. Why does this pattern repeat? Because metals don't lie. Shortages surface in the plumbing first, spreads, premiums, borrowing costs, long before they show up in price alone. If you're watching the right indicators, you see stress building, while everyone else is still watching charts. Here's the tell. When front-month futures start trading flat or tight to 3-month contracts, the valve is closing. Normal market structure is contango. Future months trade higher than spot because of carry costs. When that flattens, it means someone needs metal. Now, not later. Circle this. We're seeing consecutive days of tightness in the spread. Not backwardation yet, but compression. That's the early warning. If spreads flatten tomorrow, the valve is closing faster. Not telling you to buy or sell, showing you what to watch. Now layer in the second mechanism, the paper to physical squeeze. Futures can sprint. Futures are liquid, fast and leveraged. You can move billions in notional exposure in seconds. Physical can't teleport. Bars weigh 1,000 ounces. They sit in vaults in London, Zurich, New York. Moving them takes logistics, trucks, insurance, settlement, assay verification. When futures run and physical can't keep up, you get dislocation. And dislocation forces repricing. Here's how it works. Futures markets set price discovery most of the time. COMEX in New York, LBMA in London, those are the benchmarks. But when delivery stress rises, price discovery shifts to whoever controls physical inventory. Imagine you're a refiner in Switzerland. You've got 5,000 ounces of silver scheduled for delivery to an electronics manufacturer in 2 weeks. Futures just rallied 8% in 3 days. You sold forward contracts to hedge your inventory at $78. Now spot is $85. Your hedge worked, but only if you can actually deliver the metal. If lease rates spike because everyone's scrambling to borrow metal to meet delivery obligations, you're paying more to borrow than you're earning on the hedge. If premiums gap because retail buyers are suddenly willing to pay $6 over spot instead of $2, you're leaving money on the table by delivering into your contract instead of selling into the retail bid. That's stress. And stress shows up in 2 places: LBMA settlement dynamics and COMEX delivery windows. LBMA trades unallocated accounts, meaning metal gets settled in book entries, not bars, most of the time. But when someone requests allocated delivery, the chain tightens. Vaults need to match serial numbers, weigh bars, verify purity. If too many requests hit at once, settlement delays start appearing. We're not there yet, but we're seeing early signs, lease rates ticking up, which tells you borrowing demand is rising. On COMEX, it's delivery notices. When open interest stays high going into expiry and notices spike, it means futures holders want metal, not cash settlement. That pulls registered inventory out of the system. We've had 3 consecutive months of net draws from registered stocks. Not massive, but persistent. Think about that. Persistence means the mismatch isn't one time, it's structural. Now, this can resolve 2 ways. Orderly repricing. Spreads stay flat. Premiums inch up gradually, and price rations demand over weeks. Everyone adjusts. No chaos. Disorderly squeeze. Something breaks. Backwardation appears. Premiums gap suddenly. Someone defaults on delivery. Margin requirements change. Price spikes hard, fast, and liquidity evaporates temporarily. Which path we take depends on how fast demand keeps pressing and whether supply can catch up. But here's the key. You don't need to predict the path. You need to watch the calendar. Stress shows up before expiry. If open interest into the next delivery window stays elevated and registered inventory keeps draining, that's your signal the squeeze could tighten. Watch the calendar. Stress shows up before expiry. Not advice. Pattern recognition. Here's what you need to sit with. Everyone's asking, will silver hit 100? Wrong question. The real question is, what happens at $100? Because $100 isn't the story. Behavior at $100 is the story. Think about it. At $100, you're going to see headlines. You're going to see retail FOMO. You're going to see talking heads on financial networks saying new paradigm or bubble mania, depending on which channel you're watching. But what really matters is who blinks first, paper or physical. If futures blow through $100 on momentum and leverage, but physical premiums stay stable and delivery flows smoothly, that's a paper-driven move. It can reverse just as fast as it rallied. If premiums gap at $100, meaning retail buyers are suddenly paying $8, $10, $12 over spot because dealers can't source inventory, that's a physical-driven move. That one doesn't reverse until supply catches up or demand breaks. The difference is everything, and you won't know which it is by watching price. You'll know by watching the plumbing. Who blinks first? Paper or physical? Stay with me, we're almost there. Let me give you the scenarios and the watch list. Scenario 1, orderly climb. Spreads stay flat but don't flip to backwardation. Premiums inch up gradually. $3, then $4, then $5 over spot. Warehouse draws continue, but at a steady pace. Lease rates rise but don't spike. This is slow rationing. Price rises, but the system absorbs it without breaking. Industrial buyers scale back marginal projects. Safe haven buyers dollar cost average instead of panic buying. Dealers manage inventory carefully. If you're a trader, this path gives you time. If you're a long-term holder, this path is boring but durable. Scenario 2, stress burst. Backwardation appears. Spot trading higher than 3-month futures. Premiums gap suddenly. $2 to $7 overnight. Warehouse draws accelerate. Lease rates spike sharply. This is fast repricing. Something broke in the delivery chain. Maybe a large fund took delivery and locked up inventory. Maybe geopolitical news spooked physical buyers into hoarding. Maybe a refiner missed a settlement window and triggered a cascade. If you're a trader, volatility explodes. If you're a holder, you sit tight and don't get shaken out by whipsaw moves. Scenario 3. Cooling pause. Federal Reserve signals shift. Policy uncertainty eases. Safe haven demand pulls back. Futures cool off. Spreads widen back to normal contango. Premiums stabilize. But inventory is still tight beneath the surface. Industrial demand hasn't changed. The valve loosens temporarily, but it doesn't open wide. If you're watching for re-entry, this is your window. If you are already positioned, you accept the pullback and reassess whether the structural thesis changed or just sentiment. No path is guaranteed. Your job is to recognize which one is unfolding. Here are the 5 signals I'm watching this week. 1. Front month versus 3-month spreads. Normal. Contango. Futures months trading progressively higher. Stress. Flat or backwardation. Spot trading at or above deferred months. Why it matters. Tells you if someone needs metal now versus later. 2. Dealer retail premiums. Normal. Stable. 2 to 3 over spot. Stress. Sudden jumps. $5, $7, $10 over spot. Why it matters. Retail is the canary. When dealers can't source inventory, premiums gap first. 3. COMEX warehouse daily changes. Normal. Small fluctuations. +6. 100,000 ounces. Stress. Persistent draws, especially in registered stocks. Why it matters. Registered inventory is what backs deliveries. Consecutive draws signal structural mismatch. 4. Silver lease rates. Normal, low and smooth, under 1%. Stress. Sharp spikes 2% plus overnight. Why it matters. Borrowing pain means someone's scrambling to cover delivery or short positions. 5. Options skew. Near $100. Normal. Balance between calls and puts. Stress. Heavy upside call demand. Skew tilts bullish. Why it matters. Shows where the crowd is leaning. Doesn't predict direction, but shows positioning. Risk cluster. What could break the move? Volatility spikes. If implied volatility doubles in 48 hours, liquidity dries up and spreads blow out. Policy surprises. Fed pivots dovish unexpectedly. Safe haven demand collapses. Margin changes. Exchanges hike margin requirements, forcing leveraged longs to liquidate. Liquidity gaps. A flash crash in futures triggers stop losses and cascades lower. Sentiment whipsaw. Retail euphoria peaks, smart money fades, and momentum reverses fast. Defaults or delivery failures. If a major participant can't settle, trust breaks and markets freeze temporarily. Could reverse. Can't know timing, only structure. If you're a trader, respect the volatility. Manage size. Use stops. If you're a long-term holder, accept that pullbacks will happen. Know what you own and why you own it. Here's the bottom line. Price is the headline. Plumbing is the truth. If you track signals instead of stories, you put yourself in the group that doesn't get shaken when sentiment whips around. You're not reacting to headlines. You're watching the mechanics that drive headlines. Inventory is a valve, not a tank. When flow exceeds supply, price does the work. Paper can sprint. Physical can't teleport. When delivery stress rises, behavior changes. And behavior at $100 matters more than $100. Not telling you what to buy, not predicting where price goes next week, showing you what to watch and how to interpret it. If you're tracking spreads, you'll see stress building before it shows up in price. If you're tracking premiums, you'll know whether the move is paper-driven or physical-driven. If you're tracking warehouse flows, you'll spot structural mismatches early. Your job is to understand the pattern, not predict the exact top or bottom. Drop a comment. Which signal are you watching this week? Spreads or premiums? If you got value from this breakdown, subscribe. We do this every time markets flash pressure signals. Metals, credit, volatility, wherever the plumbing speaks first. And share one insight with someone in your circle who's watching metals. Build the informed tribe. Final thought. The crowd chases price. We watch the valve. The crowd asks, will it hit $100? We ask, what happens at $100? The crowd reacts to headlines. We read the plumbing. That's the edge. Oh, stay sharp. Stay disciplined. And remember, you're ahead of the story if you're watching now. See you in the next one.